Philippine economy is growing. But when you strip away the headlines, the numbers tell a different story. The foundation is fragile. Momentum is slowing. And some of the biggest weaknesses we're facing right now aren't coming from global turbulence alone. They're self-inflicted. So today, I want to lay everything out cleanly, without drama, without doom. Just the facts, the context, and the patterns shaping the country's direction. Let's start with the basics. Real GDP expanded by around 5.6% in 2024. On its own, that number sounds respectable. But when you look at quarterly performance, you see a clear deceleration. Growth in the first half of 2025 hovered around 5.4 to 5.5%. Then, by the third quarter, it dropped to about 4%, the weakest rate since early 2021. For a developing country trying to climb out of a pandemic-era slump, slowing growth isn't a small issue. It signals fatigue in the system. And when the government quietly lowers its growth target from 6 to 8% to 5.5 to 6.5%, that's a sign that even official expectations are adjusting downward. A strong economy should accelerate as conditions improve. Ours isn't doing that. Inflation in mid-2025 came in at around 1.4%, with a 6-month average of 1.8%. Again, that sounds great at first glance. But inflation that drops too low often points to another problem: household demand that isn't strong enough to support rising prices. When people are cautious, when wages can't stretch, when local industries aren't creating enough sustained activity, prices stay flat. And the Banco Central knows this. They've already brought policy rates down to 5.25% to stimulate movement. But lower rates can only do so much when structural demand is weak. By the end of 2025, government debt is projected to sit around 61% of GDP. The deficit in 2024 was about negative 5.7% of GDP, and the country is still running a current account deficit of roughly negative 3.8%. These numbers matter because they shape how much fiscal space the government really has. Every peso spent on interest payments is a peso not spent on infrastructure, agriculture, health, or state-led industrialization. And when the country consistently imports more than it exports, the pressure falls on foreign exchange reserves, a vulnerability made worse by external shocks. Foreign direct investment remains low at around 1.9% of GDP. For a country trying to industrialize, that number is thin, and it shows. In the second quarter of 2025, services grew by almost 7%, and agriculture grew by about 7% as well. But industry, the sector that truly drives long-term productivity, managed only about 2%. Construction collapsed from nearly 16% growth in 2024 to around 2% in 2025. A consumption-driven economy can produce short-term spurts of growth, but it can't transform the country. And we're seeing exactly that. Tourism used to contribute about 12 to 13% of GDP. It was one of the country's most reliable engines, fast-moving, job-generating, and spread across regions. But foreign arrivals remain weak. In 2023, the Philippines recorded only around 5 million arrivals, far below the official target of 6.4 million. In 2024, the number rose slightly to about 5.95 million. And by the first 10 months of 2025, Foreign arrivals were only around 4.3 million, showing that the recovery still hasn't regained its pre-pandemic strength. Meanwhile, our neighbors recovered at a much stronger pace. In 2024, Thailand welcomed more than 35 million visitors. Vietnam brought in around 17.6 million. Malaysia recorded roughly 25 million. And Indonesia drew about 13.9 million international arrivals. We lag behind every major ASEAN neighbor, even those with fewer natural attractions. Tourism isn't just a vanity metric. It feeds local jobs, foreign exchange reserves, small enterprises, and regional economies. When tourism stalls, the entire current account suffers, and it's happening precisely when the country needs this sector the most. Now, to be fair, some of these pressures are external. The global economy is unstable. The US tech and asset bubble is deflating. Japan is dealing with an unstable yen and volatile bond markets. Europe is stuck in stagnation and tight monetary policy. When the big economies slow down, emerging markets feel the drag through weaker demand, weaker tourism, and weaker investments. Global interest rates remain high as the US Federal Reserve keeps money flowing back into American financial markets. That pulls capital out of countries like ours, weakens the peso, and raises the cost of debt. And the global push for de-risking, basically the US encouraging countries to distance themselves from China, disrupts supply chains across Asia. Countries with weak industrial bases are hit the hardest. The Philippines is one of them. All of this creates a difficult environment. But even then, not everything we're facing is because of global turbulence. This is where the economic story becomes political. China is Asia's biggest source of outbound tourists, our top trading partner, a major provider of infrastructure financing, and a potential driver of railways, industrial parks, and energy projects. And yet, the current foreign policy stance is openly antagonistic. You see the consequences clearly. Before tensions escalated, China was the second largest source of foreign visitors. Today, those numbers remain far below pre-pandemic levels. Diplomatic tensions, militarized rhetoric, and inconsistent visa policies all contribute to the slump. This hits hotels, airlines, coastal towns, small businesses, and foreign exchange reserves. It's a direct economic cost from unnecessary geopolitical tension. Several major railway projects that were already in the pipeline, financed through Chinese channels, stalled or were abandoned entirely. Those projects weren't just about transportation. They were catalysts for industrial corridors, jobs, and regional productivity. Without them, the country loses decades worth of strategic opportunities. When political messaging becomes hostile, it creates uncertainty in trade flows. Filipino exporters feel that immediately. Farmers, manufacturers, and logistical networks all absorb the shock. What we're seeing today is a classic case of choosing geopolitical alignment over economic pragmatism and paying for it. When you place everything together, the slowing growth, weak investment, fragile tourism, external shocks, and foreign policy misalignment, the picture becomes clearer. Growth is slowing instead of accelerating. Industry isn't expanding at the rate needed for structural transformation. Job quality remains low. Fiscal constraints limit the government's ability to invest in development. External vulnerabilities expose the peso to pressure. The country remains dependent on remittances and consumption. Governance issues continue to dampen confidence, and foreign policy decisions are actively weakening economic opportunities. This is why the headline numbers don't tell the full story. If you look at the bigger picture, two forces shape the trajectory of the Philippine economy right now. First is global economic turbulence. The world is going through a difficult phase, from asset bubbles to interest rates to supply chain shifts. These pressures are real, and no country can fully escape them. Second is domestic strategic misalignment. This is where the country is failing itself. Instead of pursuing cooperation with Asian neighbors, strengthening ties with China, and embracing a multipolar framework that supports sovereignty and economic independence, the country is leaning heavily into a US-centric security posture. And that alignment doesn't come with the economic benefits people expect. The US offers military presence, military equipment, and military narratives, but it does not offer the industrial corridors, the tourism flows, the railway infrastructure, the energy partnerships, or the development finance that neighboring Asian countries are benefiting from. Aligning with Washington might satisfy certain political narratives, but it doesn't create factories, jobs, or growth. And that's the reality shaping our economy today. The Philippines isn't collapsing, but it's not moving toward long-term stability either. It's stuck in an uncomfortable middle, a place where growth exists, but transformation doesn't, where opportunities exist, but politics gets in the way, and where the country could benefit immensely from Asian cooperation, yet chooses tension instead. The path forward is clear: a sovereign, Asia-centered, development-focused strategy. But until we move in that direction, the numbers will continue to look exactly the way they look now: fragile, uneven, and uncertain. Thank you for watching. If you want to stay connected, you can follow me on my social media pages. And if this kind of work resonates with you and you want to support it, you can do that through Buy Me a Coffee at buymeacoffee.com/janwriter, or through Gcash using the QR code at tiny.cc/janwriter. Your support genuinely keeps independent writing alive. And if you found this video useful, consider subscribing to the channel. Like the video, leave a comment, and share it with someone who might need clarity on this topic. Every bit of engagement keeps this space alive, so I can keep talking to you directly. Thank you, and I'll see you in the next video.